Video 5B. Some more mortgages, a couple more examples. So after a down payment, the Bells obtain a 25-year, $110,000 conventional mortgage. 25-year, $110,000. Now they said conventional mortgage. The house cost $160,000. Instead of $160,000 house, they got $110,000 mortgage. So the mortgage is the principal. 10.5%. 10.5. Two points. So determine the amount of the down payment. That equals the cost minus the principal. So that's 160 minus 110. Clearly the difference was $50,000. So they put $50,000 cash down on the house. What's the cost of the points? Now remember, the points is off of the mortgage, not the cost. So each point is 1%. So 2 points is 2%. So points equals 2% times the mortgage. That's easy enough to do, right? Two decimal places, so 2,200. So up front, before they signed any papers, they agreed to pay $2,200. That's probably less than their rate, although the rate's kind of high. You can imagine it might have been a point or a percent or 1.5% higher. It might have been 11.5, 12, who knows. Find the amount of the monthly mortgage payment. So I'm going to use the table because the table is straightforward. We just find 10.5 and it's 25 years, so the number, the V number, is 9.44182. That's your V number. That's per thousand. So how many thousands are there? The mortgage is 110,000. So there's 110. And you multiply those two numbers together and you'll get the monthly payment of $1,038.60. So that's the P&I, so-called P&I. So what's the total amount the Bells will pay for the house? So once again, we know the monthly payment, so the total cost will be the monthly payment times the number of months. Well, 25 years times 12 is 300. That's 300 months. Plus, what else do they pay? They paid the down payment, $50,000. So if you do the calculator work here, you'll get guess what I forgot? What did I forget? Who can see it? We just calculated the points. So we have to also add the points. I'm sitting here thinking, I forgot something. Right. So this is P&I per month times 300 months. This is down payment, so that's part of the principal. This is part of the interest, the points. So you have 300 times M plus the down payment plus the points. So the total cost will be $363,780. So the house was valued at a cost of $160. They paid more than double that. This is typical. A lot of houses, you pay double over the span of the life of the mortgage for what the actual original cost was. How much of the cost will be interest, including the points? So that's easy enough. We just subtract the value of the house. So the total interest would be 363,780 minus 160,000. So it looks like the total interest they paid is 203,780. Like I said, it's more than 100% of the original cost is interest. All right, the amount of the first mortgage payment that applies to the principal. So out of this first $1,038.60, how much will go toward principal, knocking it down the next monthly interest? So we're looking first for I1. So we take the original principal. That's what they started with, 110,000 times this is, I better rewrite it so you remember it. PRT. So P was 110,000. R is 10.5%. And T is 1/12. 1 month. So if you do this calculation, you'll get $962.50. That's the interest from the first month's payment. So the principal for the first month will be $1,038.60 minus the interest of $962.50. When you do the subtraction, you get $76.10. That's how much is subtracted from the 110,000 when you calculate the second month's interest. And like I said on the earlier video, that keeps going down. Obviously, if I make this number smaller, this number here smaller, because these two stay the same. If this gets smaller, then the interest gets smaller, which means the principal goes up. But the P and I always add up every month to the monthly payment. And that's when you get an amortization schedule, you'll see the P and I statement. It'll always balance out. It's always equal to this every month. But the interest goes down, principal goes up. All right, one more. Okay. Kathy wants to buy a condo for $95,000. That's the advertised cost of the condo, $95,000. The land taxes on the house are $1,500 per year. And the homeowner's insurance is $336 per year. The bank requires a 20% down payment. and 1.5 points at closing. And the rate is 5.5%. Kathy has a gross income of $4,000. So Kathy earns $4,000 every month. She has 15 monthly payments of $135 remaining on her van. I'll just put 15 in parentheses. The bank will approve her loan if she has a total monthly house payment of principal, interest, property taxes, and insurance that is less than or equal to 28% of her adjusted gross income. So we have to adjust this. This is her monthly gross. We have to adjust that. So let's do that first. Actually, let's just follow the list so I don't get lost. What's the required down payment? Well, that's 20% of 95,000. So 1/5 of that is 19,000. That's the required down payment. So what's the cost of the points? Well, it's 1.5%, which I changed to. This is equivalent to 1.5%. I changed it to a decimal, times the principal. Well, the principal has to be this subtracted from that, so it's 76,000. You could do that pretty quick in your head, right? And so the points will cost her $1,140. So she paid that to lower this. That's essentially what it means. Okay, what's 28% of her adjusted monthly income? Well, her adjusted monthly income is $4,000 minus $135, because we have to account for her any outstanding loan payments. I think it's 9 or more, 10 or more. I'm not quite sure, but the bank will let you know for sure. So her adjusted monthly income is $3,685. Or there I go with my dyslexia. $3,865. So 28% of her adjusted income is 0.28 times 3,865. So that's how much. That's her maximum limit on her spending for everything. The P&I, the taxes, the insurance have to be coming less than that, or she won't get the loan. That's the guidelines that the banks follow. I don't think it's a force of law, but it's pretty close. You're just not going to get the loan. You have to leave 72% of your income for just living. You may want to buy a car. You may get married, whatever. But you have to allow for that. So what's the monthly payment for the principal and interest? That's M. So we can do the table. I like the table. So we find 5.5 in the table, and we go to how many years was it? Let's see. It didn't say. Let's see if it says in the 25. So 5.5%, 25 years. The number 6.14087 times the number of thousands. There's the principal, 76,000, right? The principal and the down have to add up to the cost. So times 76. So her monthly P&I is $466.71. Well, I think things are looking good for Kathy, because this is less than half of her adjusted monthly income. But we still have to add in what's her total monthly house payment. So monthly pay is the $466.71. That's the P&I, plus 1/12 of the taxes, plus 1/12 of the insurance. Now, you don't actually pay the insurance company and the city the taxes on a monthly basis. The bank takes care of that. They escrow the amounts, and they build it up. Because the insurance is only due once a year, and taxes are typically due twice a year. That's the way most cities work it. So when you do the arithmetic here, you get $619.71. So does Kathy qualify for the loan? An emphatic yes. So how much of the first mortgage payment will be applied to principal? So once again, we need I1. So this is part G. I1 is P times R times T. So the original principal is $76,000. The rate is 0.055, and it's 1/12. So the original first month's interest will be $348.33. That's the first month's interest. So the first month's the deduction in the principal, let's call it delta P. The deduction in the principal for the first month will be $466.71 minus $348.33. So it's going to go down to $118.38. That's the answer. First we got to find the interest. We subtract that from the monthly P&I, and that gives us the reduction in principal. Okay. What's the total amount she'll pay for the condo with this mortgage? Now that doesn't include the taxes and the insurance. This is just what P&I. So once again, the total cost to her will be the monthly payment for P&I, $466.71 times 300, plus the down payment, plus the points. So there's your P&I that goes for 25 years, 300 months. There's your down payment, and there's your points, which are considered interest. When you add those up, the total cost is $160,153. So it's not quite double the original value of the condo. That's because this is a lot lower percentage than the one we had earlier. Remember, it was 10.5%, or something, I think it was. The prices go up dramatically, but when you get a lower rate, this is not a bad rate. It's about a moderate rate, and you can see that it's not quite double. Double would have been $190,000, so she's below double. And then what's the total interest she paid? So total interest, just subtract the $95,000. So that'll be $65,153. So she came in with a pretty good deal. I'd say Kathy got a pretty good deal. So that's it for mortgages. We have one more quiz left, quiz 6, which will be annuities and sinking funds. Those are like for retirement savings. And I'll see you then for video 6. Dr. K, out.